Let's dive in. Imagine you get this secret genius playbook, right? Something promising to cut through all the chatter on a really complex topic. Well, that's kind of what we're doing today. We're looking at stablecoins, and there's this new U.S. law. But maybe it's not quite what it seems on the surface.
Exactly.
We've been digging into the latest newsletter from the Macro Butler. It's called the Genius Stablecoin Playbook. So our mission here is, well, to unpack what this Genius Act actually is, what it means for stablecoins, how they fit into the big global financial picture, and really the most important part, what does this all mean for your investments? Let's try and find those key takeaways.
Yeah, and what's really interesting is how this piece of legislation, which sounds pretty dry, actually connects to some huge financial challenges the U.S. is facing. It's a much bigger story than just crypto rules.
Absolutely.
Yeah.
So let's start with the basics then. What exactly are stablecoins, and what's this genius attempt to tame them?
Right. So think of stablecoins as crypto's attempt to be, well, grown up. The whole idea is they're digital tokens, but they're designed to hold a steady value, usually pegged to the US dollar, maybe other assets. So unlike Bitcoin, with its crazy ups and downs, these are meant to be usable for payments, for saving, without the wild price swings. The newsletter actually calls them the designated driver of the crypto party.
Ah, okay, I like that, the designated driver. But haven't some of these drivers maybe had one too many themselves? They haven't always been stable, have they?
No, exactly. That's been the big issue. Some issuers got, let's say, creative with what backed their coins. The source mentions things like apparently junk bonds counting as reserves, and we've seen some really spectacular collapses, leaving investors with, as the newsletter puts it, regrets and memes. Not ideal.
Yikes. Regrets and memes. So before this Genius Act, was it really that messy? Like the Wild West?
That's how this playbook describes it, yeah. Wild West of crypto, light on regulation, heavy on sketchy promises. And, well, predictably, that lack of rules got exploited. You ended up with stuff that looked a lot like, Ponzi schemes. And the source notes that even now, people don't always know what's really backing some of the big stablecoins.
Okay, so enter the Genius Act. This is Congress finally stepping in with a rule book.
That's the idea. This newsletter frames it as Congress's first serious attempt at giving stablecoins a proper framework. And it points out it's a bipartisan bill, which, is pretty rare these days. The stated goal, protecting consumers from stablecoin shenanigans.
All right, shenanigans. So what are the actual rules in this playbook meant to stop those?
Well, they're pretty specific according to this. First, 100% backing. And it has to be cold, hard U.S. dollars and treasuries.
Right.
The playbook makes a point. No Dogecoin, no WeWork shares allowed as reserves, none of that funny business.
Okay.
And for the really big issuers, over $50 billion. They need annual audits. Plus, and this is important, monthly reserve disclosures. So transparency.
Right. Real assets, transparency. What else?
It explicitly bans issuers from pretending they're backed by the government, Uncle Sam or the FDIC, making that really clear. It also bans risky reserves like corporate bonds, and it actually requires them to have actual risk management, which, the source adds dryly, is kind of a novel idea for this space.
Actual risk management, imagine that.
And the huge state-regulated ones, they now have to follow these federal rules too.
Seems pretty thorough. And there was something about protecting the little guy if things go south.
Yeah, they highlight this as a rare win for the little guy. Basically, if a stablecoin does implode, the people actually holding the coins, get dibs on the reserves. Before others, like the lawyers, or as the source puts it, people waiting for their yacht payments.
Okay, that definitely changes things for holders. So the official line is, this is all about preventing another crisis.
That's the narrative. Washington trying to stop stablecoins from becoming another house of cards. Though, interestingly, this newsletter points out the Genius Act kind of slipped by unnoticed. The news was all about other stuff. A manipulator-in-chief, this big, beautiful bill, potential tariffs. You know how it is.
Yeah, easy for something like this to get lost. Okay, stepping back a bit, how does this U.S. move fit into the bigger global picture? What's happening elsewhere with stablecoins?
Well, this playbook finds it fascinating that while the U.S. was debating all of this, other places were already moving. It says further east, Singapore and Hong Kong had already quietly put on their regulatory big boy pants.
Oh, really? What were they doing?
Singapore's MAS, their regulator, put rules in place demanding real money backing, not, as they put it, banana tokens. And issuers had to be ready to pay out on demand. Hong Kong apparently just said nope to algorithmic stablecoins altogether. They insisted on, boring old things like full reserves and real assets. So the contrast the source draws is Asia was building actual guardrails while Washington was still playing crypto charades.
Right, so others were ahead of the curve. What about Europe? Are they doing anything?
Yeah, the newsletter touches on the EU's digital euro project. Says they're fast-tracking it, maybe using U.S. progress as an excuse. They're apparently aiming for a quick and dirty version by maybe October 2025. And this is framed against worries about war escalation and potential Eurozone debt crisis needing things like capital controls. But the source suggests the real goal might be different, maybe full-blown peer-to-peer atomic settlement and keeping public money central. Think programmable euros.
Okay, interesting. Let's bring it back to the U.S. then. The Fed's been looking at stablecoins too, haven't they?
Oh, yeah. They did a study, January 2024, and this newsletter highlights the finding that stablecoins were, quote, only kind of stable, and only if you squint. The study also pointed out most of the action is retail traders on secondary markets. The primary market, that's institutions, and the peg, the stability, it depends on arbitrage, as long as there's no panic.
And we're talking serious money here, right? Tether, USDC, DAI. What kind of scale are we looking at?
The whole stablecoin market, around $250 billion, which the Playbook points out is like the size of New Zealand's economy, or McDonald's market cap. It's substantial. Tether alone is massive, $152 billion market cap, though the source does question how clear its reserves really are.
Yeah, that size definitely brings up the systemic risk question. Yeah. We got a taste of that during the SVB collapse back in March 2023, right?
Absolutely. And this newsletter uses SVB to show something really important. Okay, so USDC and DAI, their prices dipped below 90 cents, then recovered. Standard panic stuff. But look at their market caps. DAI actually grew. USDC shrank by almost $10 billion. Meanwhile, BUSD dropped, but Tether, USDT, its cap shot up by $9 billion. It even traded above the peg. The source makes the point, just looking at prices doesn't tell the whole drama. Something else was going on underneath.
Wow, that is interesting. So different reactions under the hood. How do the different exchanges, CEXs versus DXs, play into this for investors?
Well, they're very different beasts. CEXs, centralized exchanges, that's what most people know, use regular money, dollars, euros. They have order books, KYC checks, feels like a trading floor. DXs, decentralized exchanges, are different. No fiat, stable coins often take its place. They use automated market makers, AMMs. No ID needed. Usually the source calls it more like a hacker's playground.
Right.
And during that March 2023 chaos, this newsletter notes DEX volumes went nuts, like $20 billion compared to their usual $13 billion. And that spike happened before the CEXs fully reacted.
So activity jumped on DEXs first. What about the primary market itself? The actual creation, minting, and destruction or burning of these coins. Does that data tell us anything useful?
It should, theoretically. If everyone's selling on exchanges, you'd expect coins to be burned in the primary market. If there's demand, you expect mints. And you can track this stuff, the source notes on the public ledger like Ethereum, using data services. So back to SVB. The on-chain data showed different behaviors. DAI went into overdrive minting burning and actually gained market share. USDC, it played it cool, burned coins, but seemed hesitant to mint new ones and lost ground. So yeah, the base layer activity was distinct.
And all this complexity, the different market behaviors, it all feeds back into that bigger worry about systemic risk, which the Fed is clearly watching.
For sure. This newsletter mentions a Fed conference, May 2025, where stablecoins were called a sketchy bridge between crypto and traditional finance. And it agrees regulators should be paranoid about too many people jumping on the stablecoin bandwagon. Because runs, these investor panic attacks, they can shake the whole system, like we saw with SVB impacting traditional banks.
It's not just stablecoins causing concern, but similar digital products too.
Right. The source talks about other non-bank money-like products, things like tokenized money market funds, MMF ETFs. They promise good stuff liquidity, maybe some yield, cheap transactions. But just like traditional MMFs, they're prone to nasty runs. This playbook actually gets a handy checklist, 5 questions to spot these digital troublemakers. Like, do they make illiquid stuff seem like easy cash? Are people treating them like safe cash? Can payout suddenly disappear? Is panic contagious? Are investors calm or jumpy squirrels?
So these fancy new digital wrappers have the same old vulnerabilities underneath.
That's the core argument here, yeah.
Uh,
They share the same problems. Liquidity transformation, promising instant cash from assets that aren't instant. The moneyness illusion, threshold freakouts where they suddenly break. Contagion risk, and just plain jumpy investors. The newsletter even adds, with MMF ETFs having real-time prices, they might actually spread panic faster. Could trigger stampedes like in 2008.
Okay, tokenization offers instant settlement, which sounds like an improvement, but is there a catch the source mentions?
Yeah, there is. Instant settlement cuts some risks, sure, but this playbook raises a point. Could it also reveal too much, like showing your poker hand on a public ledger? The key question is whether the new plumbing, the settlement protocols, actually work smoothly with the existing house, the trading systems. You don't want instant settlement causing new kinds of logjams or risks.
All right, so we've covered what stablecoins are, the Genius Act, the global scene, the risks. Now, this newsletter, the Genius Stablecoin Playbook, it has a pretty controversial take on what the real genius play is here. Why does it argue this act, this push for stablecoins, is happening right now?
Okay, yeah, this is where the analysis really pivots. The source basically asks, is it just a coincidence that the Genius Act pops up right when Uncle Sam is finding it harder and harder to sell his massive piles of debt, his IOUs? They say coincidence with, heavy sarcasm. The suggestion is this is about luring crypto fans and their money back into funding the government using digital wrappers and patriotic branding.
So the argument is, the real motive isn't just protecting consumers or fostering innovation.
According to this playbook, no. The real motive is funding America's trillion-dollar deficits. It says savvy investors know the drill. Inflation plus bloated budgets ditch the contracts and cling to real property to preserve wealth. So this whole stablecoin push, it's framed as trying to patch up a broken funding model with fresh hype.
This Make America Digital, or Mad Digion they talk about. It's less about tech leadership, more about finding cash for government spending.
That's the argument being made. And they point to something specific. The April Treasury refunding minutes. Apparently, the Treasury actually asked bond dealers if stablecoins could help the market soak up more T-bills.
Hmm.
The source translates that pretty bluntly. Washington is eyeing the crypto crowd as the next big bag holder.
Wow. And didn't the Treasury Borrowing Advisory Committee, the TBAC, put a number on this? How much demand could it create?
They did estimate it, yeah. The TBAC takeaway highlighted here suggests stablecoins and these tokenized funds could potentially boost demand for treasuries by, get this, $900 billion. The source calls that not a revolution, it's a rescue mission in blockchain clothing.
So the core message from this newsletter is that stablecoins are being positioned, maybe cynically, to keep the whole U.S. dollar and government debt game going.
That's the interpretation. It's about keeping the dollar game going by wrapping IOUs in digital glitter and hoping the crypto crowd bites. They see the push since January 20th, 2025, not as financial freedom, but as seduction, aimed at YOLO investors and the financially illiterate, making them think Bitcoin or stablecoins are freedom tools when they might actually become a digital leash of future compliance.
And this newsletter doesn't hold back on Bitcoin itself either, does it? It's pretty critical within this whole narrative.
Not at all. It calls Bitcoin's origin story a bedtime fairy tale. It questions Satoshi disappearing, the untouched billions in Bitcoin, just supposed to believe it's all pure coincidence. The argument is it's naive to think Bitcoin is outside government reach. They call it traceable, programmable, and argue it actually paved the way for things like Tether, USDT, which they basically call CBDCs in disguise.
A Trojan horse, not freedom.
That's the term they use, yeah, a Trojan horse. It even mocks the idea of the manipulator-in-chief wanting to buy Bitcoin, calling it satire, and saying it's like the credits rolling on another classic bubble when political figures jump on board.
That is definitely a strong take. Okay, earlier you mentioned the big, beautiful bill. How does Section 899 of that bill fit into this picture of needing new debt buyers?
Yes, Section 899. This is presented as a really crucial and potentially damaging piece of the puzzle. The source calls it a sweeping smackdown on foreign capital. It argues Section 899 tries to turn Wall Street into a weapon. How? By taxing foreign investors to achieve U.S. goals. They call it a capital war. There's apparently a trigger-happy clause. Treasury puts a country on a naughty list. Boom, retaliatory taxes kick in. But the big one for debt funding is a potential 20% tax on U.S. income for foreigners. And that includes central banks, sovereign wealth funds, the big buyers.
Whoa. So this bill makes U.S. assets, especially treasuries, way less attractive to the very foreign buyers the U.S. relies on to fund its debt.
Exactly. This newsletter calculates it makes treasuries maybe 100 BPs less attractive. That's a full percentage point right when the U.S. desperately needs buyers. The message to foreign investors, as the source puts it, is basically, thanks for investing in America, now pay up or get lost.
Ouch.
And the conclusion drawn is this pushes those foreign investors away from treasuries and towards safety, specifically towards good old-fashioned physical gold, because gold doesn't come with surprise tax clauses or midnight executive orders. They even joke that BBB might become the U.S. credit rating.
Okay, wow. So if we connect these dots, the massive deficit potentially alienating foreign bond buyers, and then this push for stablecoins backed by treasuries, what does this playbook say investors should actually do? What's the investment strategy here?
Right. This is the so what for your portfolio. The source puts a lot of weight on the S&P 500 to gold ratio, says it's been lagging below its 7-year average since January 2025, calls that a quiet alarm. With the geopolitical situation, the war cycle heating up, stagflation risks, the priority, according to this view, has to shift. It's not about return on capital anymore. It's about return of capital, protecting what you have.
Makes sense. Survival mode almost. So what's the main tool for that? What's the antidote?
The playbook is very clear. Real assets, and the absolute top recommendation. Physical gold and silver. They call these the only truly anti-fragile stores of value. And anti-fragile meaning they don't just survive chaos, they can potentially benefit from it. Physical metal has no counterparty, no nonsense, no digital surveillance. They also suggest broader commodity exposure.
Okay, physical gold and silver first.
Huh.
What about cash or stocks?
For cash management, the advice is ultra-conservative. Stick to short-dated, investment-grade USD bonds, like under 12 months, and T-bills under 3 months. Basically, keep it safe, liquid, get a little income. For equities, be very selective. Look for lean, low-leverage businesses with strong earnings, strong free cash flow. Especially companies that actually pay taxes and might benefit from trade wars or reindustrialization trends. They specifically favor energy and commodity producers over consumer-focused companies. The catchphrase they use is, farewell Goldilocks. Say hello to golden lots.
Golden lots, I like it.
Yeah. And the conclusion for right now, May 30th, 2025, is the U.S. looks like it's in an inflationary boom, but that S&P 500 to gold ratio, it's signaling an inflationary bust might be coming sooner than people think. The advice: stay calm, disciplined, use market data tools, don't buy into Wall Street hype.
And this playbook draws an incredibly sharp line between physical gold and digital assets like stablecoins or Bitcoin, doesn't it?
Oh, absolutely, night and day. Physical gold is positioned as the only truly anti-fragile asset. It's the hedge against inflation, government overreach, fiscal meltdown. They point out even as Tether's market cap grows, long-term treasury yields are also rising, meaning bond prices are falling, and gold is still outperforming government IOUs. They highlight this negative correlation. USDT market cap is almost always negatively correlated with the gold-to-bond ratio. They call that ratio the only true indicator of the reliability of IOUs as a store of value. And they find zero meaningful link between USDT's cap and indicators of the business cycle or the S&P 500 to gold ratio, which they see as a key predictor of economic shifts. So the verdict on digital IOUs is harsh. Smoke, mirrors, and the digital shackles waiting to snap shut on we the people.
And calling Bitcoin and crypto government-sponsored magic tricks, that really summarizes their view.
It absolutely does. The argument is that real money needs to be practical, tangible, like gold. They predict Bitcoin will ultimately fail as a reliable store of value, maybe like some energy sectors did in 2022, 2023, while gold just kept performing. The key value prop for physical gold, in their view, actual autonomy. Freedom not just from the US dollar, but from all fiat currencies heading towards more centralization.
And they lean on history to back this up.
Yeah, they offer some historical spoilers. The Dow tends to beat bonds long-term, energy producers beat consumers in inflationary times, and gold consistently outshines bonds. Their ideal: physical gold, held privately. Why? No compliance checkboxes, no digital IDs, no sketchy counterparty risks, and absolutely no reliance on centralized crypto entities like Ripple or Tether. They call gold the OG protector against volatility and centralization, doing its job since ancient times, basically. It mattered yesterday, today, and especially tomorrow.
Okay, so wrapping up this deep dive then. We started with the Genius Act and stablecoins, often framed as innovation. But this Macro Butler newsletter argues it's deeply connected to the government's need to fund its debts and maybe increase control.
Right. And the alternative playbook presented is pretty stark. Forget the digital IOUs, the hype. Focus instead on real, tangible assets that are much harder for governments and banks to control, track, or, well, mess with.
It definitely leaves you with a big question, doesn't it? Could the real genius move for investors today be to actually ignore all the digital noise, the bells and whistles, and instead focus on securing wealth in things like physical gold, which has a track record of centuries protecting against precisely these kinds of government actions and currency troubles? Something to really think about as you navigate these markets.